Why? Why are mortgage rates still so high? I mean, I get asked that question multiple times a day from prospective home buyers or homeowners looking to refinance or my real estate partners. And here's the truth. It has nothing to do with the Fed meeting this week. Rates aren't high by accident. They're high because the entire system is signaling risk. And until that changes, rates stay stuck. And buyers want to hope that a Fed cut give them lower mortgage rates. I get it, but it doesn't. I mean, mortgage rates follow the bond markets, not Jerome Powell's press conference, even though personally, I'm 100% addicted to them. And right now, the bond market is telling us a very different story. Yes, we can all concede that the Fed is likely to make a cut this week. Chances, in fact, are 87%. And yes, lower inflation helps. Inflation has come down since the 2022 highs of 9%. But mortgage rates are stuck because investors see higher risk, and they're pricing for it. I mean, risk requires a greater rate of return in anything. We know that. So let's talk about what's at the heart of our mortgage rates remaining stuck. And ultimately, it's the fact that they're married to the 10-year Treasury. And the 10-year Treasury right now is glued to 4%. Now, historically, mortgage rates land about 1.6 to 1.8% above the 10-year. That's called a mortgage spread. But today, that spread is 2.2%. Now, it's lower than it was in 2022, but it's still above normal because the market believes that we're living in a higher for longer world. Now, I'm going to give you the real answer that nobody's talking about the 10-year Treasury and why it's stuck at 4% in just a minute. But suffice it to say that when demand is weak, the United States needs to pay its investors more for their investment. Let's think about that in the terms of housing. When there are fewer buyers, sellers get aggressive. We see that. Prices drop, concessions come out, giving those buyers who do jump in a greater rate of return on their money, or in bond terms, a higher yield. And higher yields in real estate means higher mortgage rates. And if investors need 4% to lend to the United States for 10 years, i.e. a 10-year Treasury, then they're going to expect a higher return for a longer 30-year mortgage-backed security. The math is boring, but it's not broken. And that mortgage spread is wider today as investors weigh all of the things that they're seeing. The first is sticky inflation that's grown above 3% again, because we all know inflation is the arch enemy of mortgage rates because higher inflation erodes longer-term investment returns. They're also seeing that small businesses are softening, like the ADP jobs numbers that we just got, going negative for 4 out of the last 6 months and wages slipping. This is raising questions about longer-term economic strength. And then there's our volatile geopolitical environment, plus record-breaking $38 trillion in national debt. Now that's giving investors fears about the strength of our financial markets. That uncertainty creates a higher risk premium or mortgage spread, and it gives us higher mortgage rates, no matter what the Fed does this week. Now, the one thing I thought could move the needle, and I haven't quite shut the door on it completely yet, is quantitative easing. The ultra-low mortgage rates that we saw during the pandemic were created by massive quantitative easing, or QE, when the Fed dumped trillions into mortgage-backed securities. Now, that was excess. It gave us mortgage rates lower than inflation. And then it inspired the biggest artificial boost in home prices in U.S. history. That was not healthy. And for now, quantitative easing is not coming to save us, not even used in a little bit. Fed Chair Powell made that very clear at last month's FOMC meeting. And with inflation still elevated, QE is politically impossible. I mean, no one in Washington wants inflation to explode again. So, to answer the question, why are mortgage rates still so high? You have to get back to the 10-year Treasury, and you have to answer, why is it stuck at 4%? So here are the 5 primary reasons. First, there's weak demand for U.S. bonds internationally. Japan and China, historically 2 of our biggest buyers, they've stepped back. So when big global players stop showing up to the auctions, we have to offer higher yields to attract new buyers. And that alone pushes up the 10-year Treasury. Second, the U.S. is issuing record amounts of debt, with borrowing needs in excess of $1 trillion a quarter. Now, this sustained high volume through 2025 has created too much supply without enough demand soaking it up. And third, investors don't trust inflation yet. I mean, they don't. And if they think that the next decade is going to average 3% inflation or more, well, they're not going to lend their money at 3.5%. They're going to demand 4 or even 4.5% just to break even. Fourth, we don't have a recession. Not yet. The economy is resilient. We see that showing up in retail sales. Rates won't collapse without real economic pain, regretfully. And right now, the economy is softening. It's not breaking. And without a full downturn, long-term yields don't fall. And finally, political and geopolitical uncertainty. Every headline adds risk, whether it's global conflict, elections, tariffs, or supply chain disruptions. Bond markets price in uncertainty with higher yields. You put all of that together, and the 10-year stays pinned near 4%, which means mortgage rates stay right where they are until the pressures unwind. Now, maybe the bigger question is, when will rates finally come down? I mean, think of the bond market as a big room full of investors who will only move when they feel safe. And right now, they don't. Rates don't fall because the Fed cuts. Rates fall when the room feels safe again, and when the entire system feels predictable. And this isn't yet a January event. It's not going to happen in a month or two. This is a multi-year story. Rates are high because the world has changed. This is our new normal. The bond market will continue demanding stronger returns while the housing market tries to heal itself from decades of excess. But I keep coming back to the same thing. The opportunities that we have today for buyers is massive. It's more inventory, it's more negotiating power, softer home prices, sellers offering concessions, and yes, less competition. And those buyers who understand how to win in this market that we're in will build more wealth than the ones who are sitting on the sidelines waiting for a 3% fantasy that will never come back. I'm Nicole Ruth, the lender you want in your corner in a market just like this, because clarity builds confidence, and confidence builds wealth.